As usual, we're joined by Hugh McManus and Mark Robertson, and filling in for our friend Cy Lynch this evening is one of the Mid-Michigan directors, my friend Herb Lemkohl from beautiful Traverse City. Welcome, Herb. We're glad to have you with us.
Thank you. I just want you to know that's an old picture, so you know, I probably should get you an updated one with my furry face.
I had one with a partially furry.
Right?
Yeah. And we also
likes it, so.
We also were going to point out that everybody thinks that's a snow sculpture there on the left-hand side. That's actually Herb shoveling his driveway.
Yeah, well, I'll tell you what, I've looked like that when I come in after snow blowing.
Well, Mark, I want to tell you that we've broken a record. This is the first time that we've been over 100 during the announcement of welcome, so I'm going to turn it over to you, and we're well over 100 participants right now, so take it away, cool. Mark.
Well, thanks, Ken, and welcome everybody, fellow Knights, and welcome to everybody in the audience who's decided to join us on this, in most places of the country, quite chilly January evening. And where it's not chilly, it's apparently extremely windy on the west coast and a bit hot down in the southwest, so some interesting weather these days. But welcome, and thanks for joining us for our January session. We're calling this one the State of the Roundtable Portfolio, just so we can run up in competition versus that other thing happening tonight. Let's go ahead and get some of the housekeeping out of the way here. No investment recommendation whatsoever is intended here tonight. Everything we do here is about educating and demonstrating a process and a philosophy. And it's the philosophy of the Modern Investment Club movement as taught by the National Association of Investors, also known as Better Investing. So we're basically demonstrating the types of things that we've learned over literally 70 years. 70 years of demonstration with that organization. I am hearing a little bit of key punching, Ken, so you might want to...
That's from me. I'm muting right now, Mark.
Okay, not a problem. All right, and again, welcome to anybody. If you've been here before, you know that we do have kind of a standing agenda. This is our standing agenda where we'll talk a little bit about the portfolio, take a look at how the results and the performance have been for the last going on 4 years now. And we'll take a look at some of the stocks that have performed very well or have fundamentally weakened such that they're on the hot seat, considering kind of a selling evaluation perhaps. And then we'll go into our stock presentations. Ken's going to present computer products and systems, CPSI. Herb's going to bring us a really innovative emerging company by the name of ShoreTel, ticker symbol SHOR. Apple, with all the carnage here over the last couple of days, ended up in my selection radar, so I'll go ahead and go with Apple as a repeat selection. And Hugh McManus finally did have a stock, you know, one of those high-quality stocks that he waits for a deeper value opportunity. McDonald's kind of fall closer to his radar screen. It's still not the type of warm and fuzzy thing that he's extremely comfortable with, but at least McDonald's is close enough to talk about here tonight. And then we'll let you guys decide which one you would pick amongst the 4 ideas suggested. A little background on the demonstration. Again, we started this back in July 2010. Pretty simple. We're basically, the 4 of us are trying to identify an intriguing or compelling investment opportunity that we happen to be studying or analyzing right now. It could be something that we own. We do try to mention that if we do. But again, an opportunity that kind of leaps off the page at us is what we are attempting to do. We don't obsess over this, but we really do take this seriously. We keep track of what we do, and we want the selections that we make to outperform the total stock market as measured by the Wilshire 5000 by 5 percentage points over the long term. That's 500 basis points if you speak that language. So that's not an easy goal. It's definitely a challenging goal, but it is what we aim for. We'd also like to see basically 3 out of 5 or 60% of the selections that we make outperform that general stock market benchmark over the time that we actually have it in the tracking portfolio. So let's take a look at how we've been doing. Again, over the last couple of years, we've been making fairly dramatic strides. This is the relative return being the difference between the the internal rate of return for the tracking stock portfolio versus the Wilshire 5000. And again, our objective there is that dotted red line. We're trying to get up to a 5% advantage to the general stock market. And you can see that we've basically been approaching that pretty steadily over the last couple of years. And we are sitting up here at 3.6%, near an all-time high. So again, have to give ourselves a little bit of a pat on the back and be grateful for the luck and good fortune that we've had. Virtually everybody participating has a positive relative return. Hugh and Ken have very strong relative returns. Herb Lemkool, Nick Strategos, Matt Spielman as guest knights have extremely high returns, and the audience has very strong returns. So that all adds up to what we see here. And again, we hope to get up into that, 5% or even better in the future. We're nearly at that 60% threshold we set for ourselves. 56% of the selections have outperformed the market, and we know that you can do quite well if you can get somewhere into that 60% range. For those of you that might not be familiar with keeping track of that type of a metric, it's generally found that the average investor, and this is based on research at the Motley Fool, ends up in the 30 to 40% range. In other words, 30 to 40% of their selections go on to outperform the market. And so 56% is actually quite good. Just one last little thing to check in on before we dig into the portfolio itself. Here you go. This is the top 20 holdings of the tracking portfolio. And let's go ahead and, again, talk about what we're looking at here. Walgreen, at the very top of the chart, has been selected, as you can see down here, 7 times. So 7 selections. Every time a stock is selected, either by a knight, a damsel, or the audience, we add it to this tracking portfolio and we invest $1,000 in at the time of the selection. So in this case, Walgreens has been selected 7 times. $7,000 has become $13,000 in the portfolio. So that's what we basically keep track of, and then we obviously keep track of the internal rate of return for the entire portfolio. So you can see there's a number of fairly solid positions in here. The most commonly selected position, and in fact it's a candidate even for selection right now, in our opinion, Cognizant Technologies, it's one of Cy Lynch's current favorites, has been selected 8 times, and that's actually come in at $11,400. So again, going down the list, you can see some pretty interesting names. Any comments or questions on the top 20 holdings within the tracking portfolio, guys?
We're clear right now, Mark. Okay,
good. I will be selecting Apple tonight, so it'll be at least a 5-time selection. You can see it's now been selected 4 times. The $4,000 has become nearly $4,600. So again, we'll be coming back to that one in a little bit. This portfolio is on display on the home page at Manifest Investing if you just click through on the roundtable tracking portfolio. So with that, what we'd like to do is talk a little bit about portfolio management in terms of, are there any stocks in the portfolio that merit consideration for a potential sell? And what we've done here is taken that last column, the return forecast, known as the projected annual return, and basically sorted it from top to bottom. So we're looking at the bottom end of the portfolio, the companies that have the lowest return forecasts. And right now, the median return forecast for the stock market is approximately 6%. So at 6%, you can see most of these are hanging in pretty close to a market forecast. There's only a couple that are a little bit down. By the way, these 3 are Hughes passes. We just kind of keep track of the passes to see if that outperforms the market. But we can see that in general, the overall portfolio does come in at about 5 percentage points. It's just a hair short of 5 percentage points by design greater than the general stock market. And the growth is actually pretty good at 10.6, and the quality is actually quite strong at 85. So excellent quality, decent growth, just a little bit short on the projected return, but I would argue not anything to have a conniption fit over. The one stock that is on here, and Ken, this is something we might discuss, 3D Systems. It's been selected twice. It's gone up $1,200 in a matter of a few months. This is one of our non-core selections. It actually has a theoretically low return forecast, but as we've pointed out a number of times, here are a couple of the technical considerations for the company. The relative strength index is one of the things that we lean on to keep track of the momentum or sentiment behind a stock. And in this case, it's been overbought, but it's been overbought for quite some period of time. Something that a high-quality company on a heck of a growth run can do for an extended period. You could even drag that all the way back to here. And the stock price has been just soaring during this period. This indicator down here is the rate of change over a 12-month period. So you can see over the trailing 12 months, it's still doubled. And so there's a lot of price momentum in this stock. And again, for a non-core holding, the type of company, it's only 1.5% of the portfolio. The type of company that perhaps we just hang on to, even though we have this situation over here with a relatively low return forecast. Any comment on that, Ken?
Well, I will tell you, Mark, that I've been dabbling in a couple more of these 3D printers because, again, I'm not sure which one of these is going to be the one that survives 15 years into the future. These are extremely volatile. They're definitely speculative. This stock has had a 25% price swing just in the last month or so. But I'm certain that these are transformational kinds of technologies, and it's the kind of stock exactly that I want to put away and then forget about for a while. So I'm perfectly happy with just ignoring it, knowing that at least for another couple years the fundamentals aren't going to really tell me a whole lot about what's going on other than revenue. Revenue. So I want to make sure that sales stay strong. I've been looking at some more of these types of companies. X1, ticker XONE, has come onto my radar recently, and I'm taking a look at it. It's a very small company, does some software and some hardware kinds of things. So again, I'm certain that these are going to change the way that the world does business. I'm just not certain which one of these is going to survive to be the good solid stock that we all want to own 10 or 15 years from now.
Yeah, and the one
so
thing
I won't vote to get rid of it, Mark.
No, it's such a small part. I don't know. Hugh, do you have any thoughts on, this type of fairly explosive stock within a portfolio? Or, one of the things I think some people ask a number of questions about would be something like, is this a candidate for trailing stops? When we have talked about them in some cases, in fact, trailing stops served some of us quite well with Apple here a little while back. But I mean, here you can see. Go ahead.
Well, I was going to say inevitably there is a very strong linkage between risk and return. And I mean, I've said it a few times, if I look at a portfolio personally, the companies that have done the best are those that have the most risk, i.e. volatility or technology risk or market risk early on. And there also happen to be the companies that do the worst. The good thing is, as I've jokingly said, but totally in earnest, that when a stock goes to zero, it stops. But the sky is the limit. And so back 25 years ago, Amgen was such a company. 1988, that there was a certain element of risk associated with that company, and many other biotechs, many of which aren't around, but Amgen has done well. I think many people 10 years ago saw it with Taser as a good example. And there are many like that. And clearly 3D printing is something both for consumers, businesses, not only architect's office or the medical area, but it is something that will continue to grow.
Yeah, and here is a 20-year look at Amgen, and as Hugh was describing, many within this community discovered this back in the mid-1990s, and it definitely had two very substantial run-ups, and then it's recently had another very strong run-up. And again, I think all of us here, I look at 3D systems this way, would not be the least bit surprised to see one of these flat spots or a slight decline in price, and you just don't get too upset over that sort of thing. Last month, Cy pointed out the same thing with Home Depot. He was a very early shareholder in Home Depot, and every once in a while you're going to have these flat spots.
And the interesting thing
like
is, if you look back at the Amgen chart that you have there in 1994, it had lost half its value at that point. That was in the middle of the healthcare crisis, when President Clinton and his wife Hillary were looking for the first time at revamping the entire healthcare industry, and drug stocks took a huge whack. Turned out to be a phenomenal time to buy them.
Mm-hmm.
Looks like 2001, 2002 was a scary time to own this stock as well.
Mm-hmm.
That looks like a 50% drop pretty easily there.
Yeah.
Yep. So these things happen, and again, if we can get in front of them in some way, we might try, but it's not something you have to obsess over. And again, coming back to the portfolio, small pieces of the portfolio, we're not overindulging in
Mark,
anyone.
I hope everybody heard me say speculative stock and small amounts of money. I'm not abandoning better investing principles in any way, shape, or form. I can cite all kinds of our own literature where Mr. Nicholson makes the point that there's room in a mature portfolio or in a large portfolio. There's room for a little bit of speculation, a little bit of creative investing. But my own portfolios are, 80, 85, 90% up straight and parallel, and I would imagine if we were to graph this entire portfolio stock by stock by stock, we'd find that a good 3/4 or more of them were up straight and parallel as well.
Absolutely. You can tell that by the quality rating. The other thing I did want to mention is Vera Bradley on here. It's falling onto the microscope. A closer look at that one with the visual analysis, I think the growth rate, the growth forecast for sales would end up anywhere from 6 to 8%. So this number's a little bit light. And if you correct for that, it basically takes it up and out of this firing squad range. All right, and a little bit creative, so I think it kind of falls into this mix, and we'll want to hear your thoughts on emerging company investing for that too. So with that, Ken, I think are we okay on the questions box?
We're doing fine, Mark. We do have one person that would like to just have a real brief reminder about what R squared means.
R squared, are we talking about relative strength or R squared itself?
R squared just itself, the statistical measure.
Well, here we'll use Ken's chart here. The R squared for any statistical measure is kind of a measure of the straightness of a line. And so a company with a higher R squared figure would be the top one here when it comes to the CPSI visual analysis. But it really is just a measure of the randomness or the amount of fluctuation in any field of statistics. And that's, that's not the textbook explanation, but hopefully that's enough. Anytime you run into something like that, and I had a couple of customer service calls this week that were along these lines, we don't cover all that stuff in the manifest glossary. We like to point people to places like Investopedia.com to look up, answers to questions like that one too. So I would recommend that if you're not familiar with Investopedia.com that you check that out. So with that, Ken, why don't you go ahead and take away on your pharmaceutical stock for tonight, or I should say pharmacy services.
Okay, this company is called Computer Programs and Systems, and it's in the health information services industry. I've been interested in health information services, especially the codification and the electrification, if you will, of patient records, both at dentist's office and doctor's office and in hospitals and in clinical kinds of situations. I've been interested in this whole process since I discovered a company called Quality Systems. Oh, it must be a dozen or more years ago now. I rode Quality Systems for a long time, made some decent money on it, and until the company itself started to air all of its dirty laundry out in public, and at that point they had a kind of a meltdown. So I've looked for other companies doing well in this particular industry. I don't know if most of you know, but there was a mandate for all places that dealt with medical records to put these records into computerized form by a certain date, and it was a kind of a moving target depending on the size of the the institution involved. They all have gone through now what is called stage 1 of this process, and so any company, in order to grow, is going to have to, first of all, be certified in stage 2 of this process of putting patient records into a form that can be read by computer and can be shared network to network. So the first challenge that you have when you're looking at one of these companies dealing in health information services is, have they stayed current? Have they moved to certify themselves in stage 2? And I'm happy to tell you that Computer Programs and Systems, in fact, has certified itself completely as a stage 2 provider. So when you listen to some of the information coming out of the industry, you'll find that while there's no more greenfield places for these companies to grow, that would be no more virgin territory where you're converting paper records to computer records. There are many instances now where providers that are certified in stage 2 are going to be able to take customers away from providers that have not been able to certify themselves in stage 2. And that's in fact where a lot of the growth for Computer Programs and Systems is coming from. They're taking a market share from other providers that are either too small or they haven't had the technical wherewithal to certify themselves in the second stage of this whole process. Computer Program and Services basically deals with small and medium-sized hospitals, and they do it in almost every single state in the union. They're not looking to go to your local doctor's office or your local dentist's office. They're dealing with only hospitals, and they focus on small and medium-sized, and they especially are focusing on smaller hospitals that are in rural areas, because these hospitals tend to be the ones that are most underserved and that are looking to either change providers or get a service upgrade so they can compete with the larger hospitals in the larger urban areas. I'm looking at the lines, and I like what I see as far as sales are concerned. Consistent growth in sales since back in 2007 right here. A little bit of a dip in 2006 to 7, but essentially a nice growth going forward, and it looks like earnings have begun to match those. I see the slope becoming roughly the same in the two of them, and that parallel idea is very important. That means I'm seeing some actual growth. They're not being able to make the growth occur by buying back huge numbers of shares or things like that. So I like this parallel idea. The growth is slowing, and I will expect it to slow because the competition is a whole different type of competition now. As I mentioned, no more jumping in and being the first provider. It's now keeping your own customers and getting somebody else's customers. I'm going to turn this over real quickly. And I like the trends that I see in the stock selection guide. A little bit down for 2012, but still well above the 5-year average. Excellent, excellent return on equities and no debt. I also want to point out the payout ratios that this company is able to put into their dividend. They put a significant portion of the earnings directly, pay it right back to the shareholder, and that's a good thing in my estimation. Right now, with today's price, the stock is yielding about 3.5%. My investment club just put this stock on its pounce list, which means we wish we had money that we could buy it, but we're short on cash right now, so it's going to be on that list, and we hope it still stays a buy as we go forward. The PE at the current time is under the 5-year average. Generally, the PEs have bounced around so that the averages at the bottom of the columns might be a little bit high at the high side, but we think the low side is a pretty decent average. We dropped the high side down to around 25 going forward. We did adjust for the most recent 4 quarters. we get a buy with about a 12.5% par, and that comes very, very close to what Manifest Investing is staying as well. So I present for your consideration, and for addition to the roundtable portfolio, Computer Programs and Systems, CPSI.
Thanks, Ken. Let's go ahead and switch the screen back to me, I guess, and see if we have any questions on that at this point as we make the transition back.
No, it looks like we're clear. While we're making the switch, I'd like to remind you all that if you're attending the roundtable and did not get a reminder about the date, if you'll email ncavula1@comcast.net, and it's in the chat box, if you'll email that email, my wife will add you to the reminder list, and you'll get a reminder. We send out now about 700 or 800 reminders every month about the roundtable, and we're happy to add you if you'd like a reminder. Our next roundtable coming up will be on a Saturday. It'll be Saturday, March 1st, and I think we set it at 11 o'clock. Am I right, Mark?
11 o'clock in the morning. It is our black tie event with the red carpet, where we take a look and give some awards, take a look at some past performance, and trust me, there's some good stuff out there. All right.
Okay, well, let's go on to the next night then, Mark.
Okay, and let's go ahead and ring up Herb. And Herb is bringing us, the type of flavor of selection commonly reserved for the types of a Hugh McManus or a Pat Donnelly, and it's a stock selection guide visual analysis which distinguishes itself, with a noticeable lack of ease, E as in earnings. And Herb, would you like to take this one away and describe for us what you see in this company?
Okay, this is kind of an interesting story because I happen to have been a judge for the one of the home builders organizations here in Traverse City, and all their different contractors submit entries of projects that they've completed for the year for judging, and then they have an awards dinner. So I happen to have been assigned to the Windmiller, which is a local electric company, and what they did with the Traverse City area public schools. So I get over there, and they're talking about their phone system, and it was interesting because Windmiller is a company that installs electric stuff in commercial buildings, and I said, how did you get into this? And they said, well, we always did the conduit, and then somebody said, well, you're pulling the conduit, why don't you pull the wires with it? And then somebody said, well, if you're doing the wires, why don't you find the phone system and hook up the phone system? So I talked to the gentleman that they hired from within, actually, their company, who's a young man who said, I'd like to learn more about what we're doing here. And so he took it upon himself to educate himself and put in this phone system that is a rather interesting phone system because for every single one of their buildings, this connects every building they have. When a teacher or administrator or somebody goes to work for the school, they're given a phone number. That phone number travels with them no matter what building they're in. So they can be remotely connected at all times with everybody in the school. They're even talking about in the future that they will eliminate phones in the classrooms or even in some of the other buildings because the phone number will go directly to their iPad or their whatever they have for communications, and they're going to be able to take it on. So I thought it was rather interesting to be able to look at this. They're kind of an award-winning IP phone system. They're unified in communications and contact center applications or capabilities. So this is rather an interesting organization, and so when I got done with it, I said, okay, I got to look up this company and see what more they do. They're the only provider of brilliantly simple, unified business communication solutions that consistently leads the industry in customer satisfaction and lowest total cost of ownership. So this is an opportunity for a large organization that has multiple locations that wants to look at what they're doing with their phone system and how can they make it more easy to handle. What was interesting about this installation is they were given for 6 months to install this, and the installation would have taken until December, and it would have gone through into the school system. They actually installed this and started it before the September opening of the school, and they were looking at doing a complete training program. They posted the training program online. They went to the schools and they said, what is it you don't understand? And they all said, what you put in there was extremely beneficial. We understand it. We just give it to us and we'll let it go. And it's really done just a great project for them. It not only will record what's going on in the school, but they can notify individual schools if there's any issues. They can notify the parents as to a school closing and all that kind of stuff. So all the phone numbers are built right into it. It also is 4 deep. So if you lose one, like your charter cable, then it automatically goes into the fiber optic. If you lose the fiber optic, it'll go into the satellites. So there's 4 different backups of this system, so they can provide that. And as you can see, ShoreTel, their price kind of went up and down, and but as their earnings kind of missed this last market, and on the 24th of January, if you go into ShoreTel, you'll find out that they really had great earnings, great profitability. They're starting to come back and turn around. This company's been in place for since the 90s, and it's just kind of bouncing along, and it was up and down and up and down, and then all of a sudden it took off, and now it's dropped back down because of the future forecasting of the company, that they don't know if they're going to be able to continue doing that. But I think it's rather interesting to say that this is one of those technology companies that may be starting to come into play because of how all the schools and the different challenges that they have with shooters coming in, that they can lock a school down. They can do a lot of different things with this phone system and be able to help the community become a safer place. The other thing is that notice that Brunswick also is a large company that they just picked this up, and they're going to be taking it on. That you pull it up, and they figure that they're saving time by their employees by having this particular phone system in. So they have great customer satisfaction. They are a worldwide company, and so I haven't done a lot with doing a stock selection guide on this, because it is a company that hasn't made a lot of profit over the years. They did make profit earlier, and then they've kind of lost their way. They are a couple of different phone systems. Avaya is one of those, and Nortel that they kind of have replaced. So it's going to be interesting to see how they will continue to be able to add this to where they're going to go. They did pledge, like I say, 11% Friday, but the quarterly sales rose 13% over the year to $84.5 million. That beat expectations of $83 million, and so that gives them a net income of 5 cents a share compared to 4 cents net loss the same year ago. But they also are projecting revenue current year should arrive at the range of 80 to 85 million, a midpoint, and so analyst expectations were in the 84.9 million. So that's kind of where I'm at. I did pick it up. I'd asked Mark to put it into his program, and as you can see, their sales or annual rates are about 15%. It's projected to go 640 million. Their net margins are 6%. Their earnings per share are scheduled to be like 55 cents. The PE is like 30. Stock price forecast will go to 16.47 from about $7 now, which is a projected annual return of 15.9%. So this is a company that is really on the edge of technology, and so do your own homework before you decide that you're going to invest in a company like this. I have invested in it in one of my portfolios, and so I'm looking forward to some bigger things in the future. Thank you, Mark.
Okay. Thanks, Herb. And I might add just one thing real quickly. There's a number here that's basically picked out of nowhere. I mean, the sales is pretty straightforward from the visual analysis. You can see that anything in that 12 to 15% range makes a lot of sense. It's this number right here. And there's two things that we should point out. That number is selected based on an industry average, the type of, call it a feasible number for a company like this if they continue to sell and they continue to fire on all cylinders, if you will. And just as a case in point, as Herb was mentioning, they have been there. So this is not uncharted waters, and they are kind of, basically investing back in the business. So again, we're talking about, this goes kind of back to Hugh's comments about, early stage Amgen. And it's not a typical investment. It is speculative. I would say it's absolutely non-core, but it can be the type of thing that can be quite rewarding. And again, what we're saying is basically, what if they are able to achieve those precedented margin levels? And again, this is very typical for a company in that industry. I would typically look for a little bit more than that right now, but again, it's not complete science fiction that this could happen. And again, not a core holding, certainly not up straight and parallel, but kind of an interesting story. And as Hugh has mentioned and a number of other people have mentioned before, it can be a lot of fun to latch on to one of these early on as it emerges into profitability. Any thoughts or comments?
I just want to state that, by keeping your eyes open, looking around your community, this is one of those things that I didn't know anything about until I got there, and then all of a sudden it kind of piqued my interest into looking at it and doing more research on it. We always want to buy things, stocks and companies that we know something about, or we have purchased their products, or we know somebody else that's done something, some business with them, and that's why we get involved with these things, because we have that experience and we could become more educated investors as we go along.
Yeah, and it's certainly very valuable to watch in your backyard. I mean, Pittsburgh experienced 2.6, the company, ticker symbol IIVI. We had Neogen here in Michigan, so it can be a very rewarding place to be. All right, Ken, can we go ahead with the next segment?
Absolutely. We're all up to date on questions, Mark.
Okay. Well, everybody settle back, and what I'd like to do is kind of walk through a more traditional selection a little bit here. What I have done here is displayed the screening results from Manifest Investing for what we refer to as the Manifest rank. Ken, I am getting a little bit of audio in the back, a little bit of a, I'm not sure what that would be.
Yeah, I was also getting it, Mark, but it's gone at this point. Somebody evidently muted themselves.
Okay. What I've done here, and I'll demonstrate, I'll go actually to the site and demonstrate this in a second, is the Manifest rank, again, looking for those in the top 1/2 of 1%. So again, the definition of Manifest rank at our site is to basically take the return forecast for the company, the PAR, and build an index or a performance characteristic of the return forecast, the projected annual return, and the quality ranking for the company. Take those two things, build them into what we call an index or a rank, and then literally rank that statistic. So what you're literally looking for is the companies that have the highest quality characteristics with the highest but not too high return forecast. So you see a pretty good list of candidates for study here, ranging from Mindray Medical up at the top down to Infosys Technology. Find it interesting that both of the information consulting companies, Infosys and Cognizant, make the list, along with the company that I'm going to go with, Apple, down here at the top. A lot of times when I'm looking at this sort, I will spend as much or more time in the middle or towards the bottom, where these are a little bit less flashy down here. For example, TripAdvisor, interesting company, but in order to achieve this return, they're going to have to hold up a fairly high high PE ratio in the future, very rapidly growing company. Not saying it's not possible. I'm just saying, in order to get that 16%, they're going to have to achieve this. So I'd probably, in today's market conditions, kind of let that one go by the wayside. But C.H. Robinson is one that we've selected a few times. Fossil's been selected here. Coach was actually my first choice for tonight, but I backed away from it. I mean, it's been hammered a little bit. It's definitely in the loathing folder, with investors really beating up on it lately, but Apple equally getting beaten up here today. So,
Mark, our friend Ed Brown has his hand up. I'm going to unmute Ed and let him ask his question, okay?
Yeah, go ahead, Ed.
Go ahead,
Mark,
Ed.
can you hear me? Can you hear me okay, Mark?
Yeah, hi, Ed.
Hi there. Well, that's what I wanted to hear. What can you enlighten the listeners about Apple? And I realize that they missed their number a little bit, but not significantly. But what's the deal going on? Is it deserving of being hammered the way it is?
Well, anything can happen. I am going to go into that detail here in a second. So just hang tight. We're going to take a look at exactly what's going on at Apple and how it looks from a long-term perspective. But good question. It is a tough one. Let me go ahead and jump out of here and just demonstrate where that came from, though. If you go to Manifest, those of you that are Manifest subscribers, and you do the stock search, this will be slightly different because of the change in prices, maybe a little bit different because of tonight. But what I'm doing here is I'm going into the stock search where we can search on a number of criteria. But one of the things we do at Manifest Investing is I refer to it as result-based or outcome-based results. We basically have the capability to search for decent return forecasts and quality. And again, like I said before, down here towards the bottom, if you enter a minimum value of 99.5 for the Manifest rank, again, you're basically saying of the 2,400 companies, which are the companies that are in the top 0.5 of 1%. And again, it might look a tiny bit different and change from one day to the next, but you can see that's basically the same listing. And again, generates a pretty decent list of companies to dig in a little bit deeper. I see Portfolio Recovery join the list in the last day. So some pretty decent study candidates there.
Mark, I'll just chime in. I've used this screen for a couple of years, and in the last 6 or 8 months, I've been searching it just a little tiny bit differently than you do. I agree with what you said just a couple of moments ago that I'm finding better opportunity near the bottom of this very select list, and I decided, well, why not search from 90 to 90.6 or why not search from 99.0 to 99.6 or 7? In other words, give me a few more companies down near the bottom, and that's very easy to do on the searcher, to just to put a slightly different range in there, and it gives you a few more companies. It takes the top away, but it gives you a few more companies that you might not have considered that are just sitting on the cusp of that 99.5 percentile.
And again, keep in mind what we're scoring is the combination of quality and return forecast, because obviously we think that's something to go after. And you can see a number of other favorites entering the list here, companies that we have discussed fairly extensively. So that's where it comes from. So back to the list, one of the other things that we like to do is talk about second opinions. Decent second opinions. And what I'll do with a list like this sometimes is just kind of run it through the mill, and basically we do this for every single company at Manifest Investing that we cover, but we're basically asking the question, well, what does Value Line think? What does Morningstar think? What does S&P think, where Standard & Poor's offers an opinion on the company? And that's what you'll see in this slide. Forget about the blue stuff over here for a second. We'll come back to that. And what you see here is that same list of tickers, only now what I've also included is the Value Line low total return forecast. And again, just to make sure everybody's on the same page of the playbook, for any company at Value Line, and let's go ahead and pull up Apple, the number we're talking about would be this number up here in the upper left. And of course, if you've been around us for very long at all, you know that we pay more attention to the low total return forecast for any company, and regard that as one of the more powerful second opinions. So the 13% that you see there coming back to the presentation, has been corrected for the change in price and the change in time frame since that paper report was issued. So the 13 is now 17. Most of that is because of the recent price drop. So it's actually bumped up into that, almost too good to be true range. But other companies here that look pretty attractive, again, Value Line has a different opinion of the situation at TripAdvisor. And again, a lot of that has to do with the fact that it's up so significantly here in the last year. But for the most part, these are pretty good return forecasts for all of the companies that made that high quality, high return forecast listing. So Value Line checks in, and again, the more attractive company here would probably be the Apple of the world. You can see that Value Line has a bit of a disagreement. They don't see quite the opportunity in Coach. One of the things that kind of weighed on me as I tried to sift through the companies. Morningstar's fair value, they basically do the same thing as the stock selection guide, stand upside down and talk about current price rather than future returns. And basically, we basically compare the current price to this fair value, and we're looking for a current price that's less than the fair value. So in the case of Mindray Medical, the current price is at 94% of the fair value. So according to Morningstar, the stock that's most attractive here would be Coach, again in disagreement with Value Line, but Apple's not too bad in that 11% discount to fair value. And again, you see Trip coming in kind of in a avoid mode. Same thing at Standard & Poor's. They compute the fair value based on current conditions at the company, compare the current price to the fair value, and here we see that Apple actually comes in as the steepest discount. Standard & Poor's, this could be corrected, based on the stuff that's going on right now, but as of yesterday, the fair value for Apple was 738, quite a substantial discount with the current price hovering somewhere near 500. So that kind of weighs on me too with the selection. I like that 69. That's getting a little bit frothy, but in general, these numbers, according to Standard & Poor's, are pretty attractive. Okay.
Mark, Norm would like to know, why aren't there any figures for HMCBF?
HMCBF is a Canadian bank that has very little institutional coverage whatsoever, so it's actually not covered by Value Line, Morningstar, or S&P. So there's no coverage at all.
The same thing would be true of INVN then, right?
That's correct. I think Invensys, though, is in the expanded edition at Value Line. We can look later, but no coverage by any of the institutions. And again, that can be to your advantage. If you're looking for a company like Herb was describing, a lot of times if you find that company before there is any institutional coverage, sometimes that can be an advantage. Now, a couple other things.
So, Mark, we're getting a lot of questions about the unpopulated fields. That just means that if there's no numbers there, then that particular source isn't covering that particular stock, right?
That's correct.
Okay, and one more question, Mark. Did you develop this screen yourself, or can somebody else get this same screen without having to go to all the different sources?
Well, we don't publish this screen because this has published data. We'd be republishing the providers, but this is actually part of our analysis at Manifest. The opinions and the characteristics shown here for the various companies are all aggregated. So that is what the result is at Manifest, of aggregating all of these. Now, you'd have to actually go out, jot your ticker sticker down on a symbol on a napkin and go hunt these down in order to find them all.
Mark, Jeff would like to know if you would share anything about how you come up with your Fusion ranking.
Okay,
your Manifest ranking.
Yeah, the Fusion ranking is basically taking the Manifest rank and then looking at the technical characteristics of the company. And that's what you see on the left there. The three indicators. There's a relative strength index, a rate of change index, and a price pressure. And those are simply price-driven. Some people think they're voodoo, but what we're looking there, for example, in the case of TripAdvisor, this ROC, that's rate of change over 12 months, that's telling me that it's up 67% over the last 12 months. So you can see the stocks that have been colder. Apple's actually been colder compared to the market at up only 14% over the last year until the last few days. C.H. Robinson Trucking Company has actually been quite chilly. And this is basically suggesting that that Coach maybe has fallen as far as it might actually be catching some support down here and actually has more upward price pressure. And if you watch a high-quality company like Coach, if the market goes down 2% tomorrow, I would be willing to bet that Coach would probably go down less than the market because it's already been damaged. The price has already been damaged, but still ranks as a fairly high-quality company. So again,
Mark, can you repeat a simple definition on price pressure, Mark?
The price pressure is simply, again, the traders. The traders that are following, we're not traders, but we like to watch what they're doing and kind of stay out of their way when they get out of control. Price pressure is the difference between, it comes off the point and figure charts. Let's go ahead and show. Probably the easiest way to look.
Mark, before you leave this chart, Roy is asking where these numbers come from. And Roy, if you look at the bottom, you'll see that all three of these columns are sourced at stockcharts.com. So you can get these values directly off of stock charts. But again, you'll have to go ticker by ticker and copy them down. Mm-hmm. This is not some kind of a chart that Mark provides for people. You'll have to create it yourself.
Okay, and so let's actually demonstrate that for Apple. When we jump over to stockcharts.com for Apple, and let me go ahead and switch it to a 10-year chart. So we're always looking long-term, even though it's a chart. We're not day traders. We're not traders. Certainly not short-term investors of any kind here. And you're looking at a 10-year chart here for Apple. You can see that that really nice run that it had. Here's your relative strength index. Again, it's kind of down in neutral territory, and it actually has a little bit of positive price momentum based on the rate of change. The price pressure comes from point and figure charts. And it's basically, again, whether we agree with this or not, much of the investing world is looking at Apple, regarding it as bearish right now, and with a price objective as shown here of 485. So we're just comparing that price objective to the current price, saying that it's got basically some room to fall. Contrast that with Coach, and again, think about the vast majority of traders out there aren't using stock selection guides, they're using price charts. And they look at a $50 Coach with an upside because the bullish price objective is 76. So again, it's just think about it as, you know, the herd of institutional investors and traders and speculators having some price momentum there. So that's all it's intended to be, just trying to kind of blend a little bit of that in. I focus 80 or 90% of the stuff on the fundamental stuff on the right-hand side, but I will be influenced by some of the technical stuff from time to time. Here's a look at the fundamentals for Apple, and what basically happened was the company came in with a fairly flat and a little bit of a lackluster forward-looking forecast for the company, and you can see that on the visual analysis, and again, we've embedded the years ending September 2014 and September 2015 to show this is a relative flat spot. And again, you know, back during this time frame when this was happening, very few people believed that this could actually happen like this, but it has flattened off. And in fact, if you look at this 4-year run, including 2 years of forward-looking estimates, we're talking about single-digit growth rates for our once robust Apple. Now, yeah, with all the research and development that they're doing, they could restore some growth here, but you know, this is getting to be a pretty big company. They're probably not going to go back to 20 to 30% growth. Probably be closer to 8 than 30. And you can see the current estimates at Manifest are based on 10.4%. So again, factoring in some of the stuff that's gone on here in the last few days might be worthy of shaving a couple percent off of that. Profit margin in the 20% range. We'll take a look at that a little bit closer in a minute. But again, under these conditions, we're looking at a company in the mid-teens on the return forecast now that it's actually down approximately 10, maybe 12% here over the last couple of weeks, including much here in the last day or so. Here's a look on the equity analysis guide injecting that 8% number that I just showed you. Again, relatively flat sales year over year. The trailing 12 months are somewhere in that range. growing at not 15%, not 18%, not even 10%, but 8%. What does that look like? And the net margin, I went ahead and went as low as 20 here. Here's the net margin over the last several years, and this is where the spectacular story is, even beyond the growth story at Apple. I mean, coming from 10%, approaching 30%, and appearing to settle out somewhere in the low 20s. So again, if they can grow at 8%, if they can achieve 20% profit margins, and in my opinion, that is feasible for some period of time, and fairly normal PE ratio. In fact, Value Line has it at a 15 PE for the longer-term forecast. We're still looking at a pretty decent return forecast here. A couple percent of yield, but 12%. This company is going to land on its feet. I kind of throw this into the Hugh McManus school of when companies are being loathed, that's L-O-A-T-H, loathed, sometimes you got to grit your teeth and love them. And the same thing was true when Apple dropped from 700 to 300 something. You had to grit your teeth and say, you know what, I don't think they're going out of business. Oh, by the way, they've got $150 billion in the bank, and they might even do something pretty cool with that. So, you know, you don't even have to know what it is. They've just got a lot of potential. They are doing a lot of research and development. Nothing is guaranteed in this world, but I really don't think they're going out of business the day after tomorrow or anytime soon. And even if the growth rates and profit margins are even a little bit more lackluster over the long term, again, not saying anything about short-term price because that can be kind of wild and finicky. Pretty good situation here, even under a fairly adverse condition. So I don't know if that answers the question. I would just, you know, you could stay up all night reading how bad the situation is at Apple. And anytime I run into that situation, I do grit my teeth, smile a little bit, and think about Hugh and how fun it can be to accumulate stocks that are loathed. So I'm going to go ahead and suggest a repeat accumulation. This would be the 5th time that this Apple's been selected for the tracking portfolio. And we can take more questions afterwards. But with that, I think we'll switch gears and see if Hugh has found it in his gut to perhaps go after a stock this month. And he has mentioned McDonald's in previous months.
Yeah, I mean, I've been very loath to buy things recently as they've been, in my book, at least somewhat expensive, and I've bought them at a lower price.
Folks, listen to the lack of enthusiasm in his voice.
Well, you know, I have to buy something because I can't keep coming back here and juggling. I had nothing else to talk about. I finished my courses at cheerleading school, got an A, so here we go with McDonald's. No, I like McDonald's. I've always liked McDonald's. It's been a very good stock. It was actually added to the better investing stock to follow 4 years after its IPO, which is a little bit soon for NAIC, as it normally has to have a track record of 5 years, but it has done spectacularly well in that time. I think it had its IPO in the late 60s. Didn't buy in at that point, but bought into McDonald's almost 20 plus years ago, one of the very first, among the first companies that I bought, and I bought it in a low-cost plan. Back then it didn't have any kind of fees, but added them a few years later. So if we go on to the next slide.
This is the only slide I have for you, so do you...
Oh, I sent you a bundle of them. You didn't get them.
Oh, I didn't get them. Do you want to just direct me through what you want to look at, or we could switch to your computer if you'd prefer.
No, we could take a look at McDonald's here on Value Line. Yeah, I was worried because I didn't hear anything from you, so I thought... And then I sent you a little reminder. I don't know if the email here has been acting up. Anywho, McDonald's is going through a little bit of a slump right now, and it's very close, within 10 or so % of its 52-week low. I think the price is still somewhat high. I would love it if it went under $80 or so, but I can't imagine that's going to happen. It is a leader in its space. I mean, in terms of revenue, Subway has more stores. But there's some interesting statistics about McDonald's. It feeds about 70 million people a day. That's 1% of the world's population. It is in about 118 countries. It has 37,000 restaurants, more than Starbucks by almost a factor of 2. It sells enough beef to feed the entire population of, in a year, to feed the entire population of Ireland for its lifetime. It actually has employed 1 in 8 Americans, and the size of its workforce is about the same as the state of Nebraska, or if you add states like Wyoming, Vermont, and Washington, D.C. combined, that's where you get. Its financial strength, you see there on the bottom right, is A++. And when I did a stock selection guide, I was somewhat conservative, throttled back a little bit on growth, put it only at 4 or so percent, and it put it in the high end of the hold zone. But had I been as aggressive, even as Value Line is here, they believe it'll grow at 6 or so percent, and Manifest Investing, I think, had a power of closer to 9 for the next 5 or so years. I probably would have been able to push it into the buy zone. But it's a company that we all know. I mean, the statistic in McDonald's that I hate saying, but you keep reading it time and time again, that more people recognize the golden arches rather than a religious cross, and that might well be the case since McDonald's is spread in parts of the world where the cross probably wouldn't be that prominent. But it is a behemoth. As I said, Subway's a little bit bigger in terms of the number of restaurants, but McDonald's is really a real estate company in disguise. They own about 80% of the land on which restaurants are built, and that gives them rental income from their franchise holders, who also pay 8% of the top line, and it also actually gives a certain amount of stability. They've borrowed against those real estate holdings as well. It's going through, as I said, a slight bit of a rough patch now. Earnings sales have not been growing as rapidly as some would hope. They're still doing an awful lot better than any of their peers in the group, but companies like Wendy's and Burger King are coming aggressively after the proverbial 800-pound gorilla. It's holding its own. Feeding 1% of the world's population every day means that you're at the point where there's going to be no dramatic upside. So this is a stable company that gives a very nice dividend. Its dividend yield 20 years ago was horrendous, but the dividend has grown dramatically, and it now has a yield of 2 or 3 percentage points thereabout. It's big, and it adds a nice oomph to a portfolio, gives it a little bit of stability, and I will add McDonald's to the mix. And by the way, I'm sure when these slides are published online, then the presentation I had of McDonald's will be embedded in there as well.
I'll embed yours in there, Hugh. One of the things that was
I'll remember to call the next time to bug you about it.
I'm sorry, I must have shut my email down too soon. One of the things that we pointed out last month and that people really kind of resonated with was the time series graph that we call a chronicle. And you see that the projected annual return for McDonald's, even though it's not exorbitant, it never is exorbitant. It's up near a relatively high peak here, up in that 9 to 10% range compared to where it's been here over the last 4 years. And every once in a while we do take a look back at longer time frames for companies like McDonald's that manifest. But it's basically riding a relative flat spot in the stock price over the last couple of years while the fundamentals have been pretty well intact, as you see here on this chart.
Another interesting thing about McDonald's, between 2011 and 2013, it opened 1 restaurant per day in China. Staggering.
That is incredible. All right, so we'll go ahead and put McDonald's in the mix, and it's good balance for some of the other stocks, I guess. Ken, any questions or comments at this point?
No, Mark, we're up to date on the questions. I'm ready to launch the poll if you're ready to do that.
Go for it.
Okay, here comes our poll, folks. We like to have our audience participate as well as the 4 knights. So here's your chance to tell us which one of the 4 presentations this evening would you add to the portfolio, or would you choose to add none of them? You can vote now by just taking your mouse and filling in one of the choices right there. As soon as we get up to about 85% voting, we'll close the poll. We're up to 80%.
And we're going to have
It's
a clear
really easy,
winner.
folks. Yeah, it's really easy. Just go up and click one of the dots.
And even if you're here for the first time and you're a guest, your vote is welcome.
Unless you're a presenter, then you can't even vote for your own stuff.
I know it. Isn't that something, Herb?
We have a few of you voting in the question box. And folks, you got to vote right on screen. Just take your mouse and vote right on the screen. That's the way you do it. Don't put it in the question box.
You know, even Joe Biden gets to vote every once in a while.
Well, I'm going to close the polls down right now. Let's see if I can do this correctly. Close. And share the results. There we are, sharing the results.
We'll go ahead and take a victory lap, Mr. Kavula, and we'll go ahead and add CPSI to the tracking portfolio. Good
okay.
Stuff. Good stuff. That's a good-looking company.
Some of our folks that are using, that are not using laptops or desktops, Mark, can't vote in the poll, so they are using the question box. So CPSI got 2 more votes on the through the iPad channel as well here.
Well, now you're just rubbing it in.
I'm just rubbing it in, right? Okay. Let me see if I can hide this poll.
Okay.
And we'll go back then.
Just a couple things we wanted to make everybody aware of. Our red tie, I should say black tie, red carpet edition of the roundtable is coming up on March 1st. That is our February roundtable. Coming up on March 1st. It'll be at 11 o'clock in the morning on a Saturday. We'll certainly get some good press out there on it and invite everybody back. We'll probably have some special stuff going on a Saturday morning. And Ken, would you like to talk to the others?
Yeah, the publicity just went out today to those folks that live in Southeastern Michigan chapter or in Capital Area chapter or in Mid-Michigan chapter of Better Investing. We're calling it Stock Fest 2014, subtitled Becoming a Better Investor. It'll be at the Holiday Inn South in Genesee County, Grand Blanc actually. On April 12th, beginning at 9 in the morning and running to 2 in the afternoon. It includes a nice lunch. Our friend Mark will be there, and I'll be there, and we're having Ann Cuniaz from Better Investing speaking as well, along with some of our directors from Mid-Michigan and from Southeastern Michigan to round out the whole day. We'll be talking stocks. We'll be demonstrating how to do an industry study. We'll be talking about basic principles and a couple of topics that are a little bit beyond basics. And we'd love to see you there. Again, that's April 12th, StockFest 2014, Becoming a Better Investor. And then on May 15th in Chicago, you can join Mark and Hugh and myself. We're going to be at the Chicago Convention. It's actually in Schaumburg, Illinois, which is a Chicago suburb near the Chicago O'Hare Airport. I think it's the 63rd Better Investing National Convention. Starts on a Thursday evening, runs through Sunday morning. If you're anywhere near and can drive in for one or more of the days, please come and spend a little bit of time with us, say hello, and we're going to try to entertain you as well as we can and hope that you leave with just a pocket full of ideas about great things that you might want to invest in. Mark, I'm looking at the question box right now. We're just about at the end of our normal time. Interesting, Susan Macholik from Wisconsin was able to vote on her iPad this evening. So evidently those polls are finding their way to the iPad now. I don't have any other questions. I don't have any hands in the air. So if there's nothing else, we'll give people a few moments here.
Herb's got something,
Herb.
I think.
Yeah, I just wanted to let you know that on May 3rd, if people are looking for a place to come up north and have a great time to vacation, that Ken and Mark are going to be here in Traverse City at the Elks Club. That's a Saturday, and so we're looking forward to that. Traverse City's a great place. Hopefully by that time we'll have the ice off the bay and the snow off the ground. But it'd be a great spot to come up and spend the weekend and then learn something about investing with Ken and Mark.
Paul would like to know. Paul would like to know how much is the Stock Fest. And Paul, that information just went out today, the publicity information. You can go to the Mid-Michigan website on the Better Investing website. I will tell you that there's an early bird special. If you can get 3 registrations in the same envelope, then you can do it for $33 a person. And I will also tell you that we're trying to keep our costs just as low as we possibly can, and most of that money is going to end up in coffee and in lunch. So we'd love to see you there on April 12th. And again, in May, first Saturday in May, up in Traverse City. That's a $10 event, folks, and we'll even serve you as much coffee as you can drink. And we'll, again, just leave you with all kinds of great stock tips and a lot of things to think about, we hope. Mark, I'd like to tell you that we hit an all-time attendance record this evening. Cool. At one point, we actually broke 160 people. So that's the all-time attendance for the roundtable so far.
We'll have to try to take that out on the red carpet. One last other thing I'd like to do, we're coming down to the end of our annual stock picking challenge. We'll be kicking off a new one. If you go to our homepage or the blog at Expecting Alpha, there's a little bit of details on the contest. But this year's contest is comes to an end here in a couple of days, and the ladies from St. Louis absolutely blew the doors off of this year's contest with a 111% total return as of last weekend. And as I say there, that's not a typo. So
Andy's doing nothing to sneeze at either at 82% return, you know?
And again, we invite clubs and individuals to participate, and the information on doing that is there. You just need to send your selections in before the end of this weekend so that I can enter them in tracking dashboards. And just for kicks, see how the lead is holding up for the ladies from St. Louis. Just clicked on that entry right there. As you can see, their $1 million invested 1 year ago is up over $2 million. And here's Herb for tonight. Kim was in the audience and asked a question. He was in the top 10. Ken is just about in the leaderboard. Kurt's on the leaderboard. This is another one of Herb's clubs.
I'm in the top 10. How the heck did that happen?
Nice job.
I'm not on this list, and there'll be more information on that to follow.
Are we complaining again, Mark, about whether or not you got the wrong symbol again?
I don't know, Herb. You can't blame the record keeper this time, though. I don't know what he's going to do. You know?
I hate when that happens. But anyhow, anybody is welcome to join in the 2014 contest. We've already got 20 or so entries in, but please, you're welcome to join us.